we round it up tomorrow. So the only thing I'm discussing tonight is just the AOC question. So there are about 8 questions that I have been able to, gather based on our colleagues that sent out this AOC on the platform. So if you look at the question, they are as follows. The first one is that demonstrate how financial intermediary can lead to economic growth and development. Number 2, with the aid of examples, discuss all the theories of financial intermediations. Number 3, discuss structure, conduct, hypothesis, and how relevant it is to banking sector's performance. Number 4, difference between financial inclusion and financial deepening. Number 5, what are the criteria for developing a robust financial regulatory body? Number 6, we were told to understand the liquidity management, pool of fund, and asset allocation then. Number 7, write short notes on any 4 of the financial institutions. So they will give us a couple of them. You have to write a short note on 4. If you look at this now, this 6 and 7 is Dr. Oyewale, and you have to pick one of them. You know, there will be 8 questions, out of which we will answer one each. Out of which we'll take one each. So Dr. Oyewale's question is 6 and 7. So you have to pick one out of the 2. Then the one for is it Dr. Bademi? I think it's 3 and 4. Is Dr. Bademi 3 and 4? So you pick one of the 2. One of the 2, 3 and 4. Yes, financial inclusion deepening or structural conduct hypothesis are relevant. Then the one for Dr. who else again? Ogege. Either 1 or 2. I think 1 and 2 are the same thing. It's on financial intermediary. You cannot repeat 2 questions on financial intermediary. So I'm thinking maybe theory of banking might also be tested. Anyway, be that as may, our job tonight is to go through. Then I included one more, Professor Okay. I included it for myself, which is risk management. So that's just my own addition story. So our job for tonight is to review these 8 questions. So once we are done with these 8 questions, that is the end of our task for tonight. So let's start with the first one. Right? This demonstrates. So I'm going to approach this thing as if I'm in the exam hall and I want to attempt this question in the exam hall. So that is the approach that I'm going to adopt now for us. So suppose I see a question that says, demonstrate how financial intermediary can lead to economic growth and development. So demonstrate how financial intermediaries can lead to economic growth and development. So the first thing that you need to do is to define what is a financial intermediary. So that's financial intermediation, sorry. That's the first thing you do. The first thing you do is to define what is a financial intermediation. So if you look at the definition like we discussed yesterday, financial intermediation is a process of moving fund from the surplus, or is it process? Don't use the word moving. Just say the proper process of channeling is better word. Channeling fund from the surplus segment of the economy to the deficit segment of the economy through the financial intermediaries. So this is what financial intermediation is all about. When you are moving funds from the surplus to a deficit through financial intermediaries. So how does this movement of a thing now improve the economics? How does it lead to economic growth and development? That is a question. So I listed a couple of factors. So try and remember as many as possible. Number 1 is that it's mobilized savings. E.g., banks encourage people to save, right? Banks want you to bring your money. That is why Mountain, you see marketer running to your office to bring in money. So what they do is that they will gather money from people through savings. And this money that they have gathered now, they will now loan this money out to those that need the money for investment. So the mobilization of savings That is exactly. So through mobilization of savings, they are able to grant facilities to those that want to invest. So when people are investing, the impact is that economic will grow, economic will stabilize. So when you are explaining this thing, you must try to link into how it will grow the economy. When people save their money, bank is able to loan out money to people for investment. This could be in agriculture, manufacturing, or whatever. At least economy will develop when people are investing in all these things. So the first one is efficient allocation of resources. So when banks gather all this money from people, they are able to assign it to people that have credit worthiness. They don't just give us loan to anybody who doesn't meet up with the criteria. So it is given out only to those that have credit worthiness. So this reduces the risk of misallocation of fund. E.g., if you approach a bank that you need loan and they ask you the purpose, you said tell them that you want to marry, you need loan for marriage. The chances of you getting the loan is almost zero. They won't give you. But if you go to the bank that, oh, I need more loan, I want to use it to invest or so things, then the chances of getting the loan is high. So that is what is known as what efficient allocation of resources. Then facilitate investments too. Those one naira that we all of us are contributing in the banks, that the banks are collecting from us. Banks are using that money to invest. They are providing the monies to investors. And the more money that banks provide to investors, it will help the economy. It will grow the economy in terms of job creation. When people are able to do this, that is why they will be able to employ people more. So there will be job creation. Then risk management too is all about. So banks, apart from them giving out loans, they also help people to make sure that whatever money that is saved with them, that is with them, is safeguarded. So they insured all these things too. So if there is any unforeseen circumstances, at least you have something to fall back on. Then payment and settlement system. So bank also help the economics to facilitate payment and settlement system. Imagine there is no bank and I need to send money to your account. How will I be able to do that? It's not possible, right? So it is because of the bank channels or bank as facility that we are able to transfer money. I can move money into your account now. Any amount, I can move money to you now. It's because of the bank. So when we are moving money from one place to another, that means there is transaction. And the increase in the rate of transactions leads to efficiency in the economics and increase in the rate of economic transaction. So you grow economics like that. So these are just how financial intermediaries can contribute to the growth of the and development of economics. So if you see this kind of a question, please attack it from this angle. Now look at this now. Imagine banks will collect 500 million from a lot of people. They can collect this 500 million from 50 million people. Now, whatever banks have collected now, they will now give it as a loan to investors, SMEs, to go and do business. And guess what? As those SMEs are doing business, they are able to employ more people. They are able to increase the production and they are also paying tax to government. And at the same time, bank will collect that money back from them with interest. So all these things leads to what? The growth in economy. All right. So I believe that this question number one is clear to everybody, right? So if we are to demonstrate how financial intermediary leads to the growth and development, that is what I have just explained. So any question on question number one, ladies and gentlemen, is there anyone that have questions for me on question number one, please? Any question, or is there someone else that want to quickly do a quick summary of this, or I should just proceed with the other question? Or is that okay? So if no one is willing to ask question, let's move on to question number two. So question number two, with the aid of examples, please, that's the key. With the aid of what example, discuss all the theories of financial intermediation. I think we have about 6 of them, right? Or 5 or 6 of them. With the aid of examples, discuss all the theories of financial intermediation. So now, here, we are going to explain those theories. And after explaining the theories, you will give one example each. Just follow the style I use in solving this now. Now, the first theory I'm discussing is delegated monitoring. We all know that banks act as delegated monitoring. E.g., if I want to go and borrow money from bank, what it will cost the bank to conduct my risk assessment will be cheaper than what it will cost an individual to do such a thing. Because the reason is that banks have lots of access to information about everybody. So they act as a delegated monitor on behalf of the depositor. So they monitor borrowers to reduce information. So they perform a lot of monitoring. If banks grant you a facilities, for example, now, they will visit your premises to check whether truly what you have collected the money for is what you are using it to do. So all those services are rendered by banks on behalf of the depositor. The people who owns the money, they are depositor. But who is doing the cat pursuing up and down job? It is the bank. So we depositor, we have delegated the monitoring of this to the banks. That is what the theory of delegated monitoring is all about. Now look at the example now. So instead of 1,000 depositors, see, all of us that have money in the bank, instead of all of us to be chasing whoever banks gives money up and down, we don't have to. It is the banks that we act on our behalf to chase whoever they are giving our money to. Okay, so instead of 1,000 depositor individually assessing a borrower's creditworthiness, a bank can perform this role using their standardized credit analysis of tools. So this can easily be performed by the banks using their tools. So that is what delegated monitoring principle is all about. Now, the next one is information asymmetry. So, this information asymmetry simply arises because no single individual have access to all informations, right? No single individual have access to all information. That is why we have information asymmetry. So for example, this lack of information results into two things. Number one is the adverse selection. That's the risk that you will select a wrong person. Okay, the risk that you will select a wrong person. Example now, without proper screening, you can go and give a loan. In business now, the higher the risk, the higher the reward. Abi, if you are a high defaulting individual, the interest that bank will charge you will be much higher than the interest bank will charge someone that has a very good credit worthiness. So if bank now make mistakes in doing the analysis, that is known as adverse selection. Then the second one is moral hazard. Moral hazard is after we have given you the money, you fail to pay us back. That is moral hazard. So example of moral hazard is that you can collect money for a project that is not viable, but you deceive us before we give you out the money, making us thinking that the project is viable. So that is moral hazard. So you can see as I'm explaining this, and I'm also giving you example as well. So the next one is the theories of transaction cost theory. So financial intermediaries, they are able to reduce this transaction cost. The cost that it will cost an individual to chase a debtor will be far, far higher than banks, because banks, they can recruit two people in their credit department. Those two people will be in charge of maybe like 100 accounts or 200 accounts. That's how they do it. So the cost per account will be quite cheaper. All right. So look at this now. So instead of multiple firms issuing bonds or equity individually, they can access this through banks, right? So you can go through banks and get things done easily as against you doing it individually. So that is how they are able to reduce transaction costs. Then the next one is known as liquidity transformation. So here, banks are able to transform customers' deposit. When you save money in the banks, it is like a liability in the bank's account, right? Customer deposit in the balance sheet of banks is a liability. So when you save money in the banks is a liability, correct? Now, that liability that you have kept with the bank will now transfer it they will transform it into an asset, because that money that you have saved in the banks will not keep it with them. They will loan it out. So when bank loan this money out, it turns to an asset, right? So that is how, and that asset will end up generating returns to the banks. That is the principle of liquidity transformation theories. E.g., a customer deposits 1 million into a savings account, which will be withdrawn anytime it needs. And this 1 million, banks now use it to give out a loan to SME. Can you see now? So the loan that you deposit in the bank is a liability, but it was given out to SME in form of an asset. So that's an example for liquidity transformation theory. Then the fifth one is risk transformation theory. So here too, banks were able to manage a risk or transfer the risk of every depositor's fund with them to insurance. They are able to transfer the risk for every depositor's debt to insurance. And in returns, the insurance company collects what? Premium for all those risks. Okay. Then the last one is I don't think we were taught this. Let me remove this. Let's limit ourselves to the theory. We were taught those 5. I don't want to. Okay, let me leave it here. You can read it up. It's very easy to understand. That's credit rationing, whereby they try to manage how loan is given out based on the credit worthiness of the individual person that wants to collect a loan. Okay, so that is for number 2. Any questions on question number 2, AOC number 2? That's a theory of financial intermediaries and examples. Any questions, please? Okay. If there are no questions, let's look at the third one. The third theory is known as, the third question is discuss structure, conduct, hypothesis, and how relevant it is to banking sector performance. Please, those that are consistent in the class, did Dr. Obademi, did he cover this topic with us? Structure, conduct, hypothesis. Those that are consistent in the class, did he treat this topic? I'm happy to take it too, but I just want to know. Those that are in the class, did Dr. Obademi cover this topic with us? Solomon, we need your service here.
No,
did he or not?
No, Casey.
He didn't, right?
Casey, no, he did not. He only mentioned it. But it's not as if he taught us what it
AOC,
is.
right?
But he just mentioned it. Yes. He mentioned it that have you heard about?
Okay, he didn't teach it. He just mentioned it as AOC, right?
He did, yes. He didn't teach it.
He said we should go and read it.
Yes, he didn't teach it.
Okay, let me explain it now. Let's do it. We'll finish it in 5 minutes or so. So what is a structure conduct hypothesis? So this basically explains, hey, my network signal is getting low. Sorry, can you hear me? I see that my network signal is getting low. I don't know why. It should go up again. Okay, can you hear me, guys, please? I'm receiving low signal notifications here.
Yes, we can hear you.
Yes,
hello.
I can hear you. Yes, Casey,
okay.
I can hear you.
Okay, I'm receiving low signal. It's okay. Let's continue then. So when we say structure, context, conduct, hypothesis. So what this explains is that, every companies have an industry that you operate, right? Every companies have a particular industry that they operate from, right? So what this thing is explaining is that how the structure of the industry that you operate influence your own individual performance. That is the meaning of structure, conduct, hypothesis. It explains how the influence of the industries or how the structures or whatever, or the influence of the industry that a company operates affects its performance. So, e.g., if you operate in FMCG industry, so whatever happens in FMCG industry, how it influences your performance as an FMCG company, that is known as a structure conduct hypothesis. Okay, now let's try and bring it down to a financial institutions now. So let's assume that in Alaba now, you have 100 banks located in Alaba alone. So that shows that there are a lot of banks in that area. So how you are going to compete there will depends on what others are doing or how concentrated banks is in that particular region. So structure, when you look at structures now, it explains some characteristics such as what is the number and size of banks in that particular area. Entry barriers, is it that when somebody wants to come, is there any barrier to the entry? product differentiation or regulatory environment. That is the structure. Okay. For example, if on a street now, you have like 10 banks on a street, what the implication is that the chances of you getting more customer will be very slim because it will be highly competitive, because that is the structure of that industry in that particular area. Now, how do you now react to it? Structure is how that industry currently operates in that particular area that you are. That is structure. But your reaction is known as a conduct. How you react to that structural issues is a conduct. E.g., what is going to be your pricing strategies? You can use pricing strategies to be attracting people. That's why if you go to Agege market, you can be on a row like this, 100 meters. All of them will be selling the same thing. Sometimes you will ask yourself, this place, so in the entire line, they're all selling Gary. How are they making it sell? That's a very good example of structure conduct hypothesis. Where you go to some market that in the entire market, if you go to Onitsha now, there is a particular market in Onitsha, they call it building market. Everybody in that market sells building. And guess what? All of them are cashing out. The question you ask yourself is now, since they are all selling the same thing, how are they making it? So this is the conduct is how they react to that kind of a concentration. E.g., what is in pricing strategies? They use pricing to react. Interest rate, e.g., if I check that, oh, all the banks in this area, they are offering 9%, just for example. Why can't I do 8% to attract more people? Why can't I be open to give out more loan without checking plenty paper? E.g., if you need SME loan now, and you go to Zenith Bank, you are wasting your time. They are very strict there. You go to SCB for SME loan, you are wasting your time. Before they will give you that loan, you go suffer small because you bring money, they are strict. But if you go to banks like Access Banks, GT for SME loan, it will be very fast because that is their selling point. They are able to take more risk with SME, unlike those other big banks that they don't want to. Loan policy, merger. So these are the various ways, or merger, like all the small banks disturbing you, you can, Ogaya, come, let's come together and form one. That's another example. So I'm just using this in this context to understand what is a. So let me explain again now. Structure is how the industry you operate, the influence it has on you. That's a structure. Why conduct is how you react to that influence. That's conduct. How your reaction is a conduct. Then performance in the impact of this conduct now is going to have impact on your performance. E.g., it will show on your profitability. Any decision you take under conduct here, if you like increase interest or reduce interest, or increase fee, reduce fee, or you're taking more risk, any decision you take under conduct will have impact on your performance. Okay. So how does this thing now affect the banking industry? That's a question now. So so you can have a collusion of price leadership, like if there are big banks and there are if there are big banks and you have small banks, so those big banks can just take over the market, right? Or swallow the small banks. So there will be some form of collusion of price leadership. Then there will be some form of, they won't be able to charge optimum interest rate because everybody will be trying to benchmark what other people are doing. So that might also affect their revenue profile because all of them won't be able to charge higher interest rate. They will try to benchmark it to what others are charging. Then there will be greater profitability for those that are able to cash out in that kind of way. Like the big boys, we always cash out, right? Because the big boys, some of them depend more on volume as against the pricing. The volume will give them their own returns. And for the small boys too, there are lower profit margin because they will keep on reducing their pricing to compete with so that they can also make some inflows or revenue. So these are some of the how this SEP hypothesis affects the banking sectors. Okay. All right. So look at some of the examples of this in a typical way. If you remember, prior to 2005, we have about 89 banks in Nigeria. 89. I don't know how we're able to do that. I think everybody can just open one shop today and call it bank then. But is this Sanusi or Soludo came and reduced through the recapitalization? The 89 banks were reduced to 25. In that case, there are some form of a more concentrated effort in some few banks. And the impact is that those big banks started dominating the market, while smaller banks, they push them over to retail banking. Big boys focus more on corporate, while the smaller banks focus more on retail. That was the time that if you want to open an account with Zenith Bank, you need to have minimum of 50K as your balance. If you don't have 50K, they will not open an account for you because they were focusing more on the big boys then. Then GTB started this zero balance that you can open an account with zero balance GTB out also. So that is exactly what happened. And because of this thing, all those banks that could not meet up with this Soludo, whatever, AMCOM, they were taken over by AMCOM. They could not survive, right? That's the impact. While those that were able to cope, they were able to what they survive. So let me just leave it like that for SCP hypothesis. You can read up more on this material and do further research too, if it is the question that you would like to attempt in the exam. Okay, now let's move on to the next question. This should be number, is it number 3 or number 4? I don't know why it's numbering it as one. I think it should be number, let me check. The next one is financial deepening. That should be number 4. Yeah. Financial deepening and financial. This is number 4, bro. This is okay. Let's discuss this next one. The next one is differentiate between financial inclusion and financial deepening. Let me give you guys one joke or one terminology that you can use to understand. When we talk about financial inclusion, you can refer to financial inclusion as growth. Why financial deepening is development. Just note that if you know the difference between growth and development, you'll be able to analyze this now. Growth means you are just growing, but there is no value added. Development is when you grow with values. But when you are just growing without development, that is growth alone. So growth is not good if there is no development, correct? So that is the impact. So when we talk about financial inclusion, we can refer financial inclusions to growth, which means when banks keep growing, making sure that all their services are available to everybody. E.g., banks have ATM in all streets. That is growth. That is financial inclusion. They make sure that banking service is affordable and available to everybody. Okay, but deepening simply means whether those services you are provided for, whether they are now being subscribed to by people, that is financial deepening. You can open 20 ATM and nobody visits one. You are growing because you have many ATM, but there is no deepening. I don't know whether you understand this. I don't want to read climb. I'm trying to use a simple term to explain the difference between the two. So let's read now. Financial inclusion, the process of ensuring access to useful and affordable financial products and services for all individuals and businesses, especially the undeserved and low income. When you make things available for everyone, that is financial inclusion. So, but financial deepening is when those things that you have made available, people are patronizing it and it is now having positive impact on the economy. That is financial deepening. When you open ATM, nobody is withdrawing. You are growing, but no development because people are not using that service. So that's the difference between financial. So financial deepening is trying to test the impact of that your growth on the economy. If your growth does not have anything under the economy, it's just inclusion, but it's not deepening. So under deepening, you are going to use ratio to test. You can open ATM and nobody is visiting that ATM. That is deep inclusion, but there is no growth. So that's, I don't know whether you guys are getting it. Hello, can someone speak? I've been talking for a while. Are you getting this analysis? I'm struggling to explain it, but I don't know whether you are catching the gist of the difference between, or if there is anyone that have a better way of analyzing this, please. Anybody? Financial deepening and inclusion. Is there someone that wants to say one or two things about it, or I should just continue with my definition? I have series of definitions. So this is the first one I've just said now. That financial inclusion is when you are growing, but deepening is when that growth is attached with development. That's deepening. You are seeing the impact of that particular stock on the economy. Okay, not just increasing alone, but you are seeing the impact. When you are increasing the number or make something available to everybody, that is inclusion. But when that thing that you have made available, people are using it and it is having impact on the economy, that is deepening. So look at the focus now. Financial inclusion focuses on bringing more people. Okay, like under financial inclusion, marketers want to open 100 accounts. If you like, have balance or don't have balance, the one is that they are registered 100 people. That is financial inclusion.
Hello,
Marketer want to open an account. They will just give you form to fill. Hello, somebody want to speak?
yeah, can we
Hello?
say like BVN is a kind of? Can you hear me?
Yes,
Hello?
yes.
Hello. Can we say
Speak.
BVN is a form of
Speak.
financial?
I can hear you. I can.
I say, can we say BVN
Which one is
enrollment?
financial
Can we say
deepening?
it's a form of financial deepening? CBN, I mean BVN enrollment.
No, when you enroll people for BVN, that is financial inclusion. You are enrolling people for BVN, but those people, some people is inclusion, right? So it's inclusion. When marketer will go and register 100 accounts, they want to bring people into the banking system. That is inclusion. But those people, do they even transact? I know there are some accounts that I have opened because my friend is a marketer, but I don't have one naira in those accounts. So that is a financial inclusion, but there is no deepening because I just open it for opening sake. I don't know if you understand what I'm saying. There was a time that somebody, one of the OP marketers, forced me to open OP accounts. It was just the day I opened it. That was the last day.
That's what I said.
Eh?
Can you hear me?
BVN is inclusion, not deepening. BVN is inclusion, not deepening. Hello, are you getting me, please? So when marketers will just want to open accounts, everybody. But if those people are not performing transaction, that means you only did financial inclusion, but there is no deepening. Now look at how do you measure now? You measure financial inclusion, e.g., what is the percentage of people that have bank accounts? That's financial inclusion. How many people have access to ATM? That's financial inclusion. But financial deepening is what is the contribution of those people that have account to GDP? Are they even transacting? How many people are using it? How many people are transacting with their accounts? Okay, look at another examples now of financial deepening and financial inclusion. Now, for financial inclusion, opening bank account for people is a financial inclusion. Okay, look at financial deepening. You are opening a new financial instrument and people are subscribing to that financial instrument. That is financial deepening. Okay, now objective is that financial inclusion, it promotes equity and social inclusion. That is, here they will say we are not gender biased, so everybody can come and open an account. So that is financial inclusion. But are people truly using that account that they have opened? Like me, I opened OPay account. It was the last day I opened an OPay account. I know that I have OPay account. I don't use it. I don't even have the app on my phone. In that case, they have included me in OPay platform. Financial inclusion is there. But is there deepening? No, because I am not using it for anything. So there is no financial deepening. All right. So that's for financial inclusion and financial deepening. So a country can have financial deepening without financial inclusion. Conversely, a country can also have financial inclusion without having much of financial deepening. So try and relate with these statements and you are good. So I'm moving on to the next questions now. Question number 5. What are the criteria for developing a robust financial regulatory institution? So if you want to develop a financial regulatory institution, what are the criteria? So I have about 10 or thereabout criteria here. Number 1 is that legal and institutional independence. Any financial institution that you want to develop. Note that there is a difference between growth and develop. Growth means you are increasing. develop, like for example, let me use this example now. Let's say last year you are earning 100K as salary, and this year they increase your salary to, let's say, 110. In your mind, you might be thinking that you are growing and developing, but in the real sense, you are only growing, but you are not developing, because by the time you change that your salary to dollar, you will realize that what you are collecting last year is more than what you are collecting this year. You can do the math. Let's say last year your salary was 500K. 500K last year, check the exchange rate, divide it. Now, your employer increased your salary by 20%. So 20% is about 100, that's 600K. Now, the 600K you are earning, you'll be so happy that, oh, last year I was on 500, this year I'm now on 600. You'll be glad that you are growing and you are developing, but not lie. By the time you convert last year 500K to dollar, now do 600K of now to current dollar, you will discover that you are not developing, although you are growing, but you are not developing. So that's just like an impact. So how do you now, what are the criteria for developing a robust financial regulatory body? How do you develop? Number one is that you must have a strong legal and institutional independence. You can read up on this. Number two is that there must be a clear mandate. Okay, for example, look at this number one now. Is the CBN of Nigeria truly autonomy, truly independent? The answer is, you all know the answer. Okay, you all know the answers to that. I don't need to say. So then that financial institution that you want to develop must have a clear mandate and objective. They must have a clear mandate of objective. They must have adequate resource and skilled personnel to operate to. And they must also have a comprehensive regulatory framework, risk-based supervision, transparency. So these are all the factors, about 12 of them. So I would just suggest know about at least 5 to 10 of them. Okay, know about 5 to 10 of these factors and you are good. So the next one that I would like to discuss is understand liquidity management, pool of funds. So this was how the questions was written on the board by Dr. Oyewale. Remember, Dr. Oyewale will test 2 questions and you have to answer one. So if I were you, I will answer the second one on the regulatory and supervisory institution. I will give us a clue now, just like the same thing that we did for our Greek. You know, we would do the same exercise now. So let's try to explain what is liquidity. You know, liquidity is one of the way that but you manage the balance sheet of a bank, right? Through liquidity and profitability. Now, under profitability, you have your ROA, ROE, and net interest margin, right? But for the liquidity, there are 2 methods. One is the pool of fund approach, then the other one is asset allocation approach. So under this pool of fund approach, every money that you have gathered, you put all the money in one pot. You pack all the money in one pot, then you now invest them on anything. So both the money from demand deposit, the money from savings deposit, the money from fixed deposit, the money from every other whatever, you join all of them together. You now invest them on anything you like. So this approach is actually will give you a maximum higher return because you are investing more money. But the problem is that it can result into liquidity mismatch. So let's read. So this approach involves aggregating all available funds into a single pool, like I just said now. All your funds, you combine them into a single pool. You now invest them on anything you like together. Okay, so key feature of this is that there is centralized fund management because all your funds are combined into a single pool. Funds are not tied to specific liability. Liquidity decisions are made based on whatever is available. So what are the advantages of this approach? It has flexibility and easy to manage because you don't have multiple accounts. You only have one account where all your funds are deposited, either savings or either current or either fixed deposits or anything. They are all combined into one single account. Okay. Now, but it has disadvantage. Disadvantage is that there can be liquidity mismatch. Okay. You can have liquidity mismatch, e.g., if those people that own savings want to call for their money now, and you have used all the monies on long time, how will you be able to settle them? So that's a disadvantage of liquidity of this pool of fund approach. Then the second one is asset allocation approach. So under asset allocation approach, that's AAL. AAL simply means that you can only invest short-term fund on short-term investment. You cannot combine all your funds together. There is one diagram that I gave. You can read through this material. You see one diagram there. So here you can only invest fund on a particular that the one that match up with the risk is the short-term fund can only be invested on short-term investments. You cannot go and use savings to go and do a fixed asset investment. Is a mismatch because savings is short. You should use it for short investments, right? So advantage is that it's on risk management because there is no liquidity mismatch here. Every fund is reinvested based on their liquidity profile. Okay. Then its advantage is that it's more complex. It's very complex because you need to keep looking for a particular investment that meets up with the current funding that you have. So that is for liquidity, and I mean the theory of liquidity. That's the liquidity both the pool of fund and the asset allocation. So you can read up. I have one table that I prepared here, which is going to guide us. So I want everybody to take one thing away from this question number 7 now. Dr. Yewale said he will write about 7 or 8 of this institution for us. And guess what is our job? Our job is to just discuss 4. And when you are discussing the 4, you will state the definition, you will state the establishment, you will state the objective, and you will state the limitations. Only those 4 things: definition, establishment, objective, and limitation. So the first one is CBN. Definition: CBN is the apex regulatory body for monetary and financial policy in Nigeria. They are the highest. If you don't know anything, just say CBN is the highest bank in Nigeria. They are the highest regulatory authorities in Nigeria. That's CBN. And they were established in 1958, although commenced business in 1959. So note this is another keyword. CBN was established in 1958, commenced business in 1959. Now, what is the objective of CBN? Number 1 is that CBN, just write number 1, they print money. Put that one first of all. They print money. Put that one first. Print money or printing of currency. They control inflation through monetary policy. They regulate interest through their monthly MPR. They ensure monetary stability. They supervise banks, and they also sanction banks that violate whatever. They sanction banks a lot, CBN. In fact, when they sanction banks, they will take the penalty at source. They don't need them to transfer money to them because they have access to all banks' money. They will take it at source. So that's for CBN. Now, what's the limitation for CBN? And limitation here is there is a political interference here. Okay, there is political interference. Governments might want to protect the dollar or defend the dollar. They will just keep asking CBN to pump their external reserve on FX. So, like what Tinubu did. I think so far, Tinubu economic policy, in my opinion, has been the worst so far. When they came into power, what did they do? Naira floating of Naira, right? Naira went to 1,008. In fact, we had Naira about 2,000 sometimes in 2023. Naira was as high as 2,000. So they could not do anything about it. What they did was that they went to our external reserve. They keep pumping the external reserve into the sector so that there will be more dollar in circulation. And the more dollar that you have in circulation, it will reduce the exchange rate. So then Naira crash. In fact, I was pained that time because I have some dollars with me too, which it grew to 2,000, right? So suddenly that dollar now crashed to about, I think, 1,000 or whatever. We all thought it is getting better, not knowing that they were pumping external reserve into the sector so that there will be more effects. But the moment that people now got to know that, I think it was Nairametric or one whatever published that Nigeria external reserve depleted from X to Y amount, it came down. I think that was when they now realized that on this method, it will kill us in the long run because external reserve was getting wiped out. So by the time they could not pump in more money again to circulation, guess what? Dollar price went up. So mistake I did was that when it came down to 1,000, I was like, guy, I've lost half of this money already because it was as high as 2,000. Now I came back to 1,000. So guess what I did? I quickly went to go and sell my dollar at 1,000 or thereabouts. 2 weeks later, it started jumping up again. I like cried that I almost cried that God, what is this? So CBN, so far the government, so when people got to know that they were pumping that dollar into the country, it spoiled so many things. So that's for CBN. So just know that CBN was established 1958, commenced 1959, and they have a lot of objectives. To number one is the printing of currency, they supervise bank, they sanction bank, they control inflation and the rest. Okay, so let's look at number two now. Number two. So that's for CBN. Number two is NDIC. Please cram something. NDIC was established in 1988. NDIC was established in 1988. They serve as a financial safety net for depositor. Okay, and they ensure that at least depositors' money at all na in bad. It's not that NDIC will give you 100% money. For savings account, they will give about 500K. While for current, I think they give about 5 million based on the amount you have. It's not that at all. If you have 100 million, if wahala shele, what NDIC will give you is 5 million. Then the balance of 95 million, by the time they liquidate the bank, if there is anything excess, then they will now share the balance on pro rata basis with everybody that have money. They will prorate it. So that's how it works. So if you own 100 million and the bank enter wala, you'll be lucky to see 30 million back. Although 5 million is guaranteed from NDIC, then the rest you can pray to God. So NDIC, in my opinion, they are not financial safety net actually. But for exam, write it like that. For exam, write it like that. So they are like a financial safety net for depositors that provide deposit insurance and supervision of banks. They were created by 1988, and their objective is to protect depositors' fund and promote stability in the financial system. That's their objective. They protect our money. Okay. Limitation is that there is insufficient coverage. Imagine somebody having 200 million in their account and the banks enter liquidation, or the bank was taken over by AMCOM, or the bank was distressed. You now say that from that 200 million, you can only pay the person 5 million naira. Or more. Police, everybody, life. So that's NDIC. So please note I'm sure everybody knows the function of NDIC. You can explain it, but just note the year. I think that's a key marks that Dr. Yawale is looking for. Note the year. CBN, 1958, commenced business, 1959. NDIC, 1988. Okay. Then NSEC, the Nigerian Security and Exchange Commission. So this NSEC, their own is to oversee the operation in the capital market. Okay. Their own is to oversee the operation in, capital market is a market where you can buy a long-term instrument, right? Financial instruments. So what is the object? When was this established? They were established by the ISA of 1999. ISA is Investment and Security Act of 1999. So they are the one that established Nigerian Security and Exchange Commission. So it is this ISA that established Nigeria Security and Exchange Commission. So please take note of that. Just a minute. All right. So please take note. This is the third one. Anyone you can understand and cram fully. All the best. So now that we have discussed the three of them, let's move on to number 4, NICOM. NICOM. So this NICOM, their own is insurance sector is what they work with. They focus on insurance sector alone. So they regulate insurance companies in Nigeria. NICOM. Their own is to regulate insurance company in Nigeria. So they were established in 1997. Sorry. They are established in 1997. And what is their own limitations to low insurance penetration, fraud, and lot of enforcement by government? So just note all the any four you can remember. Like me, I can remember CBN easily. I can remember NDIC, 1988. I can remember this number 5, PENCOM. We all know PENCOM now. Pension Commission. They were established in 2004. And they are responsible for regulating and supervising all pension matters in Nigeria. So they are responsible for regulating and supervising all pension matters in Nigeria. That's for pension. So what are the limitations to? They also have fraud. If all of them have fraud, if they ask limitation, right? Poor management, corruption, fraud is there for all of them. So now we've mentioned 5. Let's do a summary. I want this thing to sink on everybody's head. CBN established 1958, commenced 1959, NDIC 1988, NSEC 1999 through ISA, and NICOM 1977 and PENCOM 2004. So we have Financial Service Regulation Coordinating Committee. So their own is to just coordinate the activities of the financial regulatory agencies in Nigeria, and they were established in 1994 by the CBN. So they also have their own problems too. Bureaucracy, lack of strong enforcement. In fact, if you are to list all the limitations, all the government agencies in Nigeria, they have 3 common limitations. First one is there is bureaucracy in all of them. Second one is that there is corruption in all of them. And third one is that there is poor management in all of them. Okay? So the next one is CAC. CAC was set up in 1990 under the Company and Allied Matter Act. So CAC was set up in 1990 under the Company and Matter Act. So CAC, they are responsible. I think it's CAMA 1990. Okay, please note that CAMA is not 1990 again, but the CAC was set up by the old version of CAMA 1990, please. So that is what set up CAC, the old CAMA of 1990. Know that we have latest CAMA, I think 2020 or something now. Okay, so CAC, they were responsible for registering and regulatory companies and corporate governance in Nigeria. They also have their own problem as well, bureaucracy, inefficiency, corruption, and whatever. Then we have the AMCOM. AMCOM is asset management. The own is that when they realize that you are in a problem or distress, they will just take over your company. Like the way they took over Aero Contractor. Once they see that you are facing challenges, you're having some crisis, a public limited liability company, AMCOM will take over. The objective of taking over is to see how they can restructure your assets so that the shareholders' money is not totally lost. That is the objective of AMCOM. Okay, then we have the FRS. They were established in 2007 through the FRS Establishment Act of 2007. So you know what they do and you know their own problems too. There is corruption, there is tax evasion, there is weak enforcement. Well, then we have the NFIU too. They were established in 2004 and became independent in 2018. Their own is Nigerian Financial Intelligence Unit. Their main objective is to fight money laundering. And that is why they said that if you want to transact anything beyond $5,000 for an individual and $10,000 for a corporate in the banks must flag you and report to them. So when banks send them your details, they will check whether truly that money you are sending is legit. So that's when you see people that instead of them dropping 5 million at once, they will drop $4,500,000. The following day, they will be, so that because the moment it exceeds 5 million for a single transaction, it will be flagged to NFIU immediately. So people try to be creative about that as well. So that is all about, that's all the AOC, right? 7's AOC. So let me take this risk management, then we'll call it a day. Okay, risk management is the last one. This is like my own additions to the AOC. We've covered all the 7 AOC, and I'm going to share the solutions with us now shortly when I'm done. So what is risk management? First of all, let's define risk. Risk is probability that an event or a threat will occur, or it might occur, not might. Risk is 50-50. Okay, the probability that something might occur. That's a risk. Then what is the risk management? So this is a framework or process that you have put in place to manage or mitigate the risk. Is either you are able to avoid it or you mitigate it. You do one of the two. So how do you deal with risk? So I use a typical smoker, someone that smokes cigarette. There are 4 ways of managing your risk associated with smoking. Is either you avoid it, that you stop smoking. If you don't smoke again, that means the risk is gone. Or you reduce it. Let's say currently you are smoking 10 sticks a day. You now reduce it to like 4 sticks. That is reduced. Risk is still there, but you have reduced it. Ignore risk simply means that you continue smoking. Don't worry. Now, once they kill person, it go kill person one day. You ignore it. You know, because you know send you. They say now one thing they kill person. Then the last one is transfer risk. Here is when you now subscribe to HMO. You are paying heavily so that if you are sick, they'll take you there. That's transfer risk. So the risk you have is stylishly transfer it to HMO or an hospital that, okay, when I fall sick, treat me. That is So you can deal with risk in using either of these 4 approach. You avoid it, you reduce it, you ignore, or you transfer. So what are the categories of risk? There are 2 categories. The first one is a fundamental and the second one is a particular. So fundamental risk is the risk that affects all of us in the market. No one is exempted from this. E.g., Donald Trump policy in the US is checking many countries now because it's something that is global. Then I learned something that in Spain, they've declared a state of emergency because there is no electricity. I was like, these people, are they normal? They should come to Nigeria and see how we cope without electricity. Most of the European nations, Spain, France, Portugal, one side of Europe, currently they don't have light. So they declare state of emergency in Spain because of light, no light, so that police will be everywhere. Because what they said is that people are committing suicide because there is no light. They are killing themselves. I was like, you people should come and stay in Nigeria for 1 week. That's for that. So fundamental risk is risk that affect everybody. Exchange rate, political instability, inflation, and government policy. Why particular risk? This one is specific to one person alone. Is not for everybody. So if you now want to manage your risk, I listed out 6 processes that you follow in risk management. The first one is you identify the risk itself. Okay, what is a risk? This is a risk. Then once you have identified the risk, the next stage is which assets will be affected by this risk. So you identify those assets that will be affected by the risk. So once you have been able to identify the asset, then you conduct your risk assessment. Your risk assessment can give you like 10 or 15 different action points, but you cannot take all the 10 to 15 action points. You have to prioritize it. That's step 4. You now do a risk prioritization or allocation. So once you have been able to prioritize, and your prioritization is from a risk-based approach, you start from the asset with the highest risk, then you come down like that. So when you do the prioritization, you implement and you continue to monitor and evaluate. Okay, that is the 6 stages involved in risk management process. So what is a risk as response? So this is basically how an entity responds to risk. And I told you there are 4 T's to this. The first one is either you terminate the risk. The risk totally, you avoid it. How do you terminate it? You stop smoking. You don't smoke again over and over. Or you treat. Whenever you are falling sick, you are treating yourself well. You can do that as well. Or you transfer, e.g., you subscribe to HMO. So that anytime you are sick from the smoking of cigarettes, HMO can take over from you, treat you free of charge. Okay, then tolerate means that don't worry, let me be smoking. I won't kill the man. So these are the various ways you can respond to risk. All right, so we have type and sources of liquidity. How do banks source for liquidity? Number 1 is liquidity. Type and sources of risk. Type and sources of risk in financial institutions. So what are the type of risk? We have liquidity risk, interest rate risk, market credit, and operation. I'm sure we all understand this very well, right? So I gave us this example when I was explaining it, all this process. Now, the last one, this is where I'm stopping tonight, or the end of it. Risk management techniques. Risk management techniques. So the first one is your gap analysis. This is when you are trying to check the gap between your interest income and interest expenses. So the lengthier the gap or the wider the gap, the more income you earn. The wider the gap, the more income you earn. That shows that you are earning more interest income that you are paying as interest expense. So that's what gap analysis is all about. Then the next one is gap duration. So under the gap duration, you are testing the maturity of assets versus liability. Note, under gap analysis, you are testing your interest income and interest expenses, but under the gap duration, you are testing the weighted average of maturity of your assets and liability. So that's another way of analyzing the techniques. Then when we say securitization, here is when you go and look for one moribund asset, you look for somebody to buy it over from you. That's asset securitization. So this involves pulling various financial assets such as loan or mortgage and sell them as security to investor. So all those your moribund loan assets, you sell them off so that you can get money. That is what is called asset securitization. Okay, so you can read up on sensitivity. I think the last one is the internal rating. So you can use your own internal ratings to assess your risk management process. So I've been able to cover all the AOC tonight. So my advice is that we should kindly go back again and read through this AOC. If this is the only thing, this material cover all our topics A to Z plus past question and answer. So if this is what you can just continue to read from now till Saturday, I think you should not have issue with your hair. Although tomorrow, okay, let me stop recording so that I don't keep expanding the bandwidth more. So for tomorrow evening, we might likely start tomorrow's session around 7 p.m., right? Because I have somewhere to be.